Quast is back with us, team, as we're excited to bring him back on and talk about market structure edge. So I'll let you take lead, Joel, but it's good as hell to have you back, Tim. Definitely. Good.
Happy to be back, guys. I missed you. Happy New Year. Good to see you.
Where are you today?
Where in the world is Tim Quast?
That's a reference, Mitch. I'm not sure everybody would get, but I'm right with you.
Carmen Sandiego.
Exactly.
That's old, Mitch. That's old.
I'm an old guy. What can I say?
I'm in Austin, Texas today.
Austin, Texas.
It's getting weird.
What are you doing
in Austin?
It's a family thing. There's a big
it's getting weird with it.
Celebratory bash for my wife's mother who just turned 80.
Oh,
so that's,
shout out to her. Shout out from Pre-Market Prep.
Birthday, Mom.
Happy birthday, Mom, out there.
80 years old.
80 years old.
We're all hoping to make it to 80 years old. That's
Hell
great
yeah.
life expectancy. If we can make it to life expectancy under, being day traders and the stress and all that, we're doing pretty good. So congratulations, 80 years old. Nice number.
Thank you. I was hoping to die gloriously in battle, but it's apparently too late for that.
So
Let's
Tim, please
talk about that rally on Friday. Should stocks rally on weaker wage growth as they did on Friday? And just another thing, too, was, if you hit that headline number down 3.5%, you're like, wait a second, what happened? It didn't take long for the market to react to that. But just talk about the way the market's reacting to the news.
And I don't know if you've had any conversations about this, but, one of the things that I return to repeatedly for you traders, just to remind you, what actually drives the market so that you're not fooled is that would it be rational for a consumption-based economy? Keep in mind that our economy, the United States economy, if you're talking about the drivers behind gross domestic product, GDP, that roughly, give or take, 70% of that comes from our consumption. That is the things that we buy. And so should a market rally dramatically because the rate of wage growth is slowing, that is the amount of money that people are making and the degree to which that is increasing diminishes, so therefore stocks should soar. Well, it's completely cognitively dissonant to think that it would be good for stocks if people have the capacity to consume less. I just want you to be aware of those sorts of things. And I talk all the time about how the headlines are often an attempt to explain what the market does when the market does things that appear to be irrational. And it's not that the market is irrational. It's that most of the behavior in the markets doesn't come from people thinking about what they're doing, but rather machines that calibrate prices and models that help people determine, well, where are we going to put money? And so this, to me, was a classic example of it. It's not that we didn't expect it. I had written in our market desk notes to edge users that the data, if you looked at the supply-demand balance heading into the new year, and you compared it to historical precedents, that there was a 100% probability that stocks would rise, because they always do from this level. So it wasn't a surprise. I used it, certainly, to take gains and not chances. I had a big position in McDonald's. I mean, the stock did great. Those were things that I could be very comfortable about. But it's not rational for stocks to soar because wage growth is slowing and the central bank might change the rate at which it increases the cost to borrow money. And I don't know, you'd say, well, all I care about is I just want to trade stuff that makes money. I get that. I understand that. But I want you to understand the risks and the opportunities. And that is not rational behavior. The market shouldn't move hundreds of points, 2-3 percentage points, because the central bank changes or might change the cost of credit. That shouldn't drive the market. That it does should tell you not to have an expectation that it will necessarily behave rationally. And so then that has to feed into how you think about trading. And we can get to that.
Let's jump in and start looking, at the market structure on some of these different names. You mentioned McDonald's, and it's an interesting case because this stock has been in a relentless bull market where the rest of the stocks have been in a bear market. Clear uptrend if you bring on the 2-year charts. We're not far from all-time highs. Obviously, defense, you're going into a recession. People still eat at McDonald's because even though their prices have went up, it's still relatively cheap to everything else. So, and I mean, kids like McDonald's. My kids like McDonald's. They're not going to stop liking McDonald's all of a sudden, because, the people have a little bit less to spend. So what's it look like on McDonald's? Are you still in this trade? And if not, why did you get out?
So I'll take both pieces of that. This is supply. So if you've never seen market structure edge traders, the basis of edge is that there are rules that govern how stocks trade, and they all have to follow them. If they're part of the national market system, the same rules apply to everything, and therefore you can measure supply and demand. And the green part of the graph is demand, and this graph down here is supply. And so when demand stays steady and supply drops, there's a high probability that something benefits from that. The price rises. There can also be rising demand, falling supply produces a different kind of outcome. This to me is what I'd call a low volatility trade under normal circumstances.
Yeah.
That's spending a lot of time at 5. That is the kind of condition that I like to be in when there is uncertainty. So I am not in it, but I can always buy it again. This is how I think about it. All that matters to me is, do I keep the gains that I've generated, and do I enter at a price that is better than when I leave? And there's more to it, but that's my thinking. So when McDonald's moved well more than its volatility on Friday, that was a very good reason to me to leave. And again, I can come back, particularly if the price drops. But I would look at this equation where demand is steady and supply has dropped sharply, but now it's begun to reverse. Will I return to McDonald's? Maybe, but there might be something else that doesn't have this little uptick in supply. Supply, by the way, is short volume. It's the thing I get asked about perhaps more than anything else on Twitter, because there's this belief that there's phantom stock in the market and a lot of shorting, naked shorting. Well, it's not true. Naked shorting is illegal. It's against the rules. You can look at the threshold stocks. Those lists are published, and you can look at them, and it's generally ETFs that land on those lists. Those are stocks that where there has been a failure to deliver. Somebody has borrowed, they have a certain period of time to cover it, and that hasn't happened. And most of the time, it's a handful of stocks, like 20 stocks, and 18 of them will be ETF. So that's not the problem. The problem is there are rules that govern the supply side. The SEC permits the creation of stock to facilitate the presence of 100 shares at the bid and the offer all the time. That's what happens. And so,
you talk about that all the time, but what if they didn't do that? What if they didn't allow this? We need liquidity. We've unfortunately got rid of all of our human market makers. We don't have very many human market makers left at all here anymore. It's all bots. What if they didn't allow this? What happens then?
Well, you're absolutely right. If you look at the trade size, the average trade size in the S&P 500 last week was 100 shares. We measure that data every day. And 100 shares is the exact regulatory minimum to make a quote at the bid and at the offer. You back up 20 years ago, and it was 1,100 shares. Yeah. And so what would happen if there was nothing? Well, traders would go to buy or sell 100 shares, and you would not be able to do it because there simply would not be any supply. The market is very illiquid, really. And so it depends on almost half of the volume. In fact, it's over half right now. And the S&P 500, by the way, users of Edge can look at this every day and know exactly where the market is. Well, the market right now, sorry about that. The market right now is 50, a little over, it's 50, all the same as 51% short. 51% of the trading volume in the S&P 500 is coming from borrowed or created stock. But it makes it possible for you to trade things at a penny spread or less. So what would happen if we didn't have that system? Well, there would be violent volatility, and many times you would be unable to fill a trade. That it's a whole long discussion about
Yeah.
the stock market, but it's which is the lesser of two evils. It's a big question.
Yeah, and I mean, you're going to have liquidity on your stocks like Bank of America. It's this littler stuff too that sometimes there's just, Joel calls, these stocks, trade by appointment only.
Right.
And I mean, people want to go trade those things to go and find. And I mean, really what the liquidity providers, market makers role is to do that time gap where you've got a buyer here that wants to buy today, but a seller that wants to sell tomorrow. What the liquidity provider is really doing is, helping you out with that gap in time, especially on some of these smaller stocks. So it's a difficult thing to just say, yeah, let's get rid of all these rules here and let's just let, whatever happens, and we don't need any market makers at all. I don't know if that's a good idea either.
I agree. And the reason we talk about these things, folks, Edge Mob, is so that you can be a better trader. You have to have a basic comprehension of the mechanics of the market so you know what's coming. Just like if you were playing football, you got to know the rules.
Yeah.
Otherwise, you will be caught out. You'll be surprised. Well, the same thing applies here. I agree, and I always check this. Right. This is I'm going to check supply and demand. It will give me 2, 3, 4, 5 days. That's the advantage it should give a trader. You have 2, 3, 4, 5 days to produce a return or to get out of something when you see supply and demand changing. And it should factor into, I'll look at the spread. Curiously, McDonald's at times, as I was leaving it, had a spread of 40 cents between the bid and the offer. And, you could trade some little stock like SYNH, which has a lot of volatility, but had a good supply demand balance. And the spread was 2 pennies. So why would McDonald's have a spread of 40 cents? Well, I mean, it's a higher price stock, but those are things that you want to look at. That tells you about the amount of liquidity in a stock.
All right, let's keep moving now. One of the areas that definitely has been interesting is the industrials. We saw CAT make a decent move on Friday. Let's take a look at how maybe CAT's performing or other industrials. I don't know if you have a watch list for that, Tim, but let's dive deep.
We could do that. And as we do this, Mitch, I want to point something out that ties back to why stocks moved the way they did on Friday. So on the dashboard and I trade these too. And everybody at Edge has them. Momentum or low volatility. You're either capturing things that are likely to outperform the market, or when the market's rising, that's momentum. They have greater volatility, or they're likely to avoid big swings in the market, but still give you a benefit. And those are the things that I use all the time. And this is demand and supply. So if demand's stable and supply is falling, that's what I'm looking at. But look at this. I don't know if you can see this, but across all of these tiles, every tile represents a portfolio. Look at the key behavior. Passive, passive, passive. You could go all the way across my entire dashboard. There is not a single way that I have clustered stocks to look at them that was led by active investment in the last week.
How do you come up with that? Like, I don't want your secret sauce here. I know this is
we do.
behind, but how do you define whether, because that's a difficult thing to figure out. How do you find whether it's passive investors coming in or active investors coming in? And maybe you should just tell the difference. Tell everybody the difference between passive and active money.
So, and they're exact opposites. So passive money trades characteristics. That is, it is BlackRock, Vanguard, and State Street, or global macro hedge funds, or any model that is interested in characteristics. Passive equals characteristics. Is it market cap? Is it industrials, Mitch? And we're going to look at that. Is it volatility? Is it other? You could have a model with all kinds of factors in it that say I'm looking for rising, accelerating earnings and a top line growth of 15% or more. Those are all models. And most of the market uses models. If you look at the data today, now how do we get to that, Dennis? We have built algorithms that look at how you have to comply, and there are coming changes to these rules with the rules 605 and 606. All orders have to be executed according to rules that the SEC has established. And it's like watching a decathlon. There people huck the javelin, people run the hurdles, they do different things. And those events can be defined by how they are different from other events. Well, orders are the same. Orders that run through the market changing the price are different from a large value investor trying to get a whole bunch of MCD at the same price.
Right.
We can see how those trades execute, and it helps us model what the key behavior is. So and then active money. So passive money wants to be the benchmark because it's tracking characteristics. I want to perfectly match industrials, whereas active money picks stocks. What makes this stock better than that stock? Because I want to beat the benchmark. And then you have fast trading, which is trading price, and over half of all market volume derives from that. And then you have derivatives as an end unto itself. Maybe I buy and sell puts and calls. Well, that falls into a bucket we call risk management, because it's about using derivatives to produce a return. But you can look across here and see those are the only two behaviors that set prices everywhere in the market, therefore establishing that the market did not move on fundamental factors last week. It moved because of machines and models. Looking at industrials, here it is, Mitch. So here's industrials, led by passive, 426 stocks in it. And here's the supply demand equation across all those 426 stocks. Not bad. Demand rising, supply falling, dipping just below 50% on average across the whole group. That's not bad. When either side changes, that's when you want to be out of industrials. So if you're buying an industrials ETF, pretty good time to do it. When either side changes, leave. It's that simple.
I got one for you.
Okay.
I'm going to take a stab at it. Maybe you guys want to too. Tesla.
Okay.
Hey, don't pull it up yet. I'm going to say between 3 and 4. I'm going to go with 3.5.
3.5. Okay.
And what's going on with the volume though, Joel? Is it short volume? Is it going down? Is it increasing? What would you say, Joel?
I would say that the short volume has been decreasing, obviously, because we've had a little bit of a bounce. So
okay,
that's my call. All right, survey says
falling. Okay, let's see what
it's
we got.
Fun to try to guess. Sometimes he's right, sometimes he's way wrong.
So here it is.
Joel. Sentiment is still in the gutter.
Sentiment is still 1, and now supply is rising anew.
Ooh.
One.
This is a bad recipe.
Yeah. It is not a good recipe. That is exactly right. You don't want to buy that. You want to buy the opposite: rising demand, falling supply. Well, that's how you protect yourself. It's not whether you own Tesla, it's when. Just own it when it's going to deliver returns for you, and don't own it when it's going to hurt you. Or if you're shorting, that's probably still a pretty good short.
I can tell you the discrepancy. You got a closing price at 113 and it's trading at 117. So there's a little bit of the discrepancy. Go ahead, Dennis, and then we'll wrap things up here.
But your system, Tim, and I just want to get this.
Yeah.
You're more of a momentum. You're not trying to catch the turn, like the actual turn in the bottom in Tesla, because that's what I'm trying to do sometimes, and it's the wrong move. But you see a stock that's going straight down, 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 down. You're typically not going on that day one where it's turning. You're kind of, your system's probably waiting for a little bit more of a turn where it feels a little bit safer. Am I correct?
Right. It's a central tendency, because here's how I think, and you're a very sophisticated trader, Dennis. You know a lot, and you're going to be able to, and you, Joel, you're great experts at the market. You're going to have an advantage. So for those who don't have the time to sit and watch screens, but want to be where the competition is least, because you can't beat the machines, probably can't beat BlackRock, Vanguard, and State Street because they're too large. What do you do as a trader? Well, you want to be between them. I say when you're trading supply and demand, you have days rather than minutes or hours, and you're sitting in a spot looking at supply and demand, not looking at price. I don't trade price. I really don't care what the price is. I want to have the strongest possibility that my trade produces a return, not today or tomorrow, but several days from now. That's how I think about it. If you look at Tesla in a portfolio, here's the point to me. It's a very good tool. And Dennis, I don't know whether you'll agree or disagree. Tesla is a consumer discretionary stock. So we'll go into that portfolio, which doesn't look good. Its short volume is coming down and supply is rising, but it's way over 50%. I would avoid consumer discretionary simply because short volume is too high. Supply is too high in the entire group. But let's look at Tesla's volatility. This is key for edge traders, and their edge users who are so good at this. I've had a guy send me a note last week. He said, I've used this now for most of the year and I've made money 100% of the time following this. And he's after just 2%. He just says, I want 2%. I have put my stops and limits so that I produce 2%. And if I do these things, it produces every single time. Tesla moves 8% between intraday high and low on average over the last 5 days. Now, it can be skewed by big moves, but that's extraordinary. So if Tesla were, say, down 3 or 4% and supply and demand are diverging, that's a great time to buy because you're almost assured of producing a 3 or 4% return. That to us is a way to think about the market that reflects everything that is occurring in it and increases your chance of producing a return, traders, rather than trying to guess where the price is, or is it properly valued, or how should I think about the Tesla cutting prices on vehicles? Is that going to be good or bad? You don't have to worry about all that because all of those things are inputs into supply and demand, and you don't have to know all of them. You can just see it. That's how I think about it. I'm biased, but I think it's helpful.
Sometimes it's good to take out some of the discretionary part of it, right? And definitely threw up the link there for you guys to get your own demo, of course. Check it out, your own trial, 30 days now. And definitely check out Market Structure Edge.
And you can get $40 off the monthly rate. It's not an inexpensive tool because there's no other tool like it. But you can, using Benzinga, all caps, and you will get $40 off the monthly rate.
Well, thank you for joining us like always. Tim Quas, Market Structure Edge. We'll have you back on. Have a good one, Tim.